morning and welcome to Charting the Markets on Monday, the 12th of February 2024. The US dollar is subdued as inflation data looms, and on Tuesday we've got the Consumer Price Inflation Index, the CPI, which could give investors further clues as to the future Fed monetary policy. But today's economic calendar is pretty empty, and we have some Fed, ECB and Bank of England members speaking during the day, but apart from that, no data out whatsoever. And this comes after Chinese markets are shut for the week-long New Year celebrations, and the Japanese Nikkei 225 trading slightly up on the day, close to its 34-year record high it saw last week. And European stock indices are also following suit and also beginning the week on a positive note. Now, the main data out this week is, as I said, US CPI, inflation data on Tuesday, and then on Friday we've got PPI as well, producer price inflation, and during the week retail sales, and also tomorrow we've got German ZEW sentiment index, the economic index, which is watched by a lot of traders who look at the DAX 40 contract, for example. And then in the United Kingdom we've got CPI, unemployment, preliminary fourth quarter GDP, and also retail sales data coming out. So perhaps the British pound and the FTSE 100 will be the ones to watch for this week. So let's begin with the FTSE 100. And as you can see here on this daily financial bet chart, we are on track for our fourth consecutive day of sliding prices. And you can see that the FTSE 100 is approaching this red line here, the 200-day simple moving average at 7,547, which short-term seems to be acting as support. As you can see here, it is also very close to the mid-November and early December highs between 7,543 and 35. So we've got a pretty good support area coming in between 7,547 and 35, and expect the FTSE 100 to at least short-term stabilize in that zone. Now, if it were to be fallen through, it is quite likely that we would then be heading back down again towards not just the January low, but also the late November low between 7,403 and 7,383. So the FTSE really not looking great at the moment. Resistance comes in around the orange line here. That is the 55-day simply moving average at 7,605, and last week's low just slightly below that, 7,000-ish. 600, I should say, sorry, 7,600-ish. So that's pretty good resistance. And unless we were to take out the high seen last week at 7,710, the downside seems to be the way to play the FTSE 100 once again. In Germany, things are looking far more positive. As you can see here, this is the DAX 40 daily financial bet, and we did retest on Friday the October to February uptrend line, but that held as support as we continue to trade sideways in this low volatility sideways trading range, awaiting, as I said, US CPI data. You can see here really not much happening over the last 2 weeks. Of course, we made a new record high last week above the 17,000 mark at 17,066 on this daily financial bet, but since then we've just traded sideways above last Monday's low at 16,856, and provided we stay above that low, further sideways trading with the bullish bias should remain in play. And the story is quite similar in the United States, where you can see here the Wall Street, that's the daily financial bet for the Dow Jones Industrial Average, trading higher, still very close to its record all-time high made on Friday of last week at 38,896. And you can see here we remain above the October to February uptrend line, but are also losing upside momentum. And that may indicate that over the next few days we could continue to consolidate and perhaps even fall through this uptrend going back to October of last year, and if so, may actually fall back to last Monday's low at 38,209. But it doesn't have to mean that we are going to come off. It could just mean that we are consolidating again short-term trading sideways before we head to another new all-time record high. So the fact that we are this extended, and yes, we are hugely extended over the last 15 weeks since the beginning of October, or I should say the end of October, I believe, we've had 14 positive weeks in the Dow Jones Industrial Average. I can just show you that on the weekly chart here. It's quite incredible, the advance we've seen since the end of October of last year. And yes, we can see some loss of upside momentum, which is totally normal in this sort of scenario. But it doesn't mean that a reversal should be seen, because a lot of investors start to worry more and more about a reversal probably happening. And it may well do, but at the moment we're just trading sideways, losing some upside momentum, consolidating, and then the data will probably tell us whether we can continue to rise towards the 40,000 mark here, the psychological level with regards to the Dow Jones Industrial Average, or whether indeed we will see a corrective move lower. Now, what is interesting from a sentiment perspective, if you look back to the 1950s, you can see there's a pretty high probability of equity indices in the Western Hemisphere and Northern Hemisphere basically underperforming, and we quite often see the worst 2 weeks of the year from a seasonal point of view at the sort of the last 2 weeks of February into March. We saw that last year, for example, on the banking crisis in the US, the regional banking crisis, and we have to see whether that will be the case again this time around. So the next few days might be interesting, especially with tomorrow's CPI data coming out as well and giving us better indication of where the Fed is heading. The US dollar has been quite subdued over the last few days as it awaits for the CPI data out of the United States tomorrow, and as we want to see inflation to slide further and continue on its downward path in the United States. And you can see here the euro against the US dollar really not doing that much over the last 3 or 4 days since last week's low at 107.23, which incidentally was made right at the December low at 107.24. And basically since then we sort of rallied to this morning's high in a subdued trading manner to 108.05, but are currently coming off again as the US dollar is basically short-term appreciating. Now you can see here from a technical perspective, provided we stay below the red line here, the 200-day simple moving average, and also the December to February downtrend line between 108.32 and 108.40, further downside is likely to be seen. And if we were to fall through this key support area between 107.24 and 23, the next downside target would be this area here, taking us back to the middle and late October highs between 106.95 and 106.39. So that would be the next downside target for euro dollar. Looking at euro sterling, we also had a positive move in the euro earlier this morning, but have since come off again. As you can see here, last week we broke out of this downward trending channel, which we had been trading in since December of last year, and that then acted as support, the upper resistance line. But at the moment, we seem to be faltering below Friday's high at 85.47 and seem to be resuming our descent. If we were to fall through last week's low at 85.16, which was incidentally made very close to the late January low at 85.14, so basically this whole area between 85.16 and 14, if we were to fall through there, we would fall probably quite a lot further. And I can tell you this because if we look at the weekly chart, you can see here that we would then be heading to levels last traded in August of 2022 and could then slide towards the mid-August of 2022 low at 83.88. So that remains a distinct possibility. As you can see here, we've been falling for the last 7 or 8 consecutive weeks with regards to this currency pair, and it looks as if further downside is likely to be seen with regards to euro sterling. Now, the British pound against the US dollar looks different. This is a 2-day chart. I want to go back to the 1-day chart. And you can see here we've been trading in a sideways trading range since mid-December of last year, and also gradually advanced from last week's low at 125.19. But this morning at the intraday high, a 5-day high, a 1 week high, we saw at 126.54. Lost upside momentum as the greenback started to appreciate again. And here, as long as we stay below the orange line, the 55-day simply moving average, I should say, at 126.76, it looks more likely that we may actually retest the early January and mid-January lows between 126.11 and 125.97, ahead of last Thursday's low 125.72 and also the red line here at 125.65. So this is a potential downside target area in the short term, provided we stay below today's high at 126.54. Now, with the US dollar not really moving that much, commodities haven't really been that active either, except for the oil price. And let's begin by having a look at Brent crude oil. And we can see here that the price of Brent crude oil last week rallied quite considerably by about 5%. But interestingly enough, now from a technical perspective, is once again being capped or trading around the 200-day simple moving average here in red on this front month daily financial bet futures contract at 81.54, and it looks as if we are starting to come off again as the US dollar is slightly appreciating today. And if we were to stay below Friday's high at 82.21, we could see a retest of the mid-January high at 80.53 and perhaps of the psychological 80 area. But provided we stay above the orange line here, the 55-day simple moving average at 78.64, further upside should actually be seen, even if short term we might see a minor correction lower. So what could that upside look like? Well, if we were to rise above Friday's high at 82.21, the next upside target would be this area here. If you look back to mid-November, late November, and also the January highs, these come in between 83.79 and 84.58 and represent key resistance. As you can see here, we've been trading in this sideways trading band since November of last year. If we manage to break out of this sideways trading range to the upside, i.e. above the late November high at 84.58, it would indicate that we're forming a long-term bottom, which could then take us all the way back up again towards the $90 area or even higher than that. So it's quite interesting to see what's happening at the moment. Short term, we seem to be struggling once again, as we have done many times before, as you can see here, in this sort of $82 to $84 area, and may, as I say, perhaps slide back towards the 80 area. But then we'll have to see whether we can hold there and then resume the ascent we saw since last week or not. Now, the gold price hasn't really done much. If we look at spot gold here, the front month futures contract, this is actually the spot gold price, excuse me. You can see here that we have tested, well, we did last week at least test the orange line here, the 55-day simple moving average at $2,035 per troy ounce, but failed there and have resumed our descent. And if we were to fall through Thursday's low, which looks pretty probable at the moment at $2,020 per troy ounce, we would then once again be heading back down again towards last Monday's low at $2,015 per troy ounce, which together with the October and the late November highs between $2,009 and $2,007 and also the mid-January low at $2,002 should act as a strong support area. So this whole cluster between $2,015 and $2,002 should be good technical support for the gold price. And as long as it remains above that area and doesn't fall through that support zone, further sideways trading is likely in play and should stay in play between these levels just above 2,000 and the highs here we saw back in mid-January and also in early February between $2,062 and $2,065. Last but not least, I'd like to mention the US natural gas front month futures, because what is fascinating here is that we continue to grind down and just fall and fall and fall. And today we're seeing a slight reversal to the upside as the US dollar is appreciating, but you can see here that we are now trading at levels last seen, if I move out onto a weekly chart, last seen in August of 2020. So we've fallen through this key support area that I have drawn in on this chart, which goes back basically to 2019. That was a support area where we held back in December of last year. Then we fell through the lows going back to February, March of last year. And this fall has then led to an acceleration to the downside last week. As you can see here, we have a longer candle to the downside. And we are now trading at levels last seen in August of 2020 and are heading down towards the 1 164 area on this chart. So further downside likely to take the natural gas prices in the US down towards this 163, 164 zone, going back to August 2020, as the weather seems to become more clement and as there is an oversupply of US natural gas at the moment in the financial markets. Thank you very much for watching Charting Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is @AxelR_IG. Have a lovely week.